Hi there, it's Alvin from Dr. Wealth. Happy New Year to you. We are into 2025 and 2024 has been a very good year for investments, even for Singapore stocks. It is up, the Straits Times Index is up more than 20% inclusive of dividends in 2024. And if you look at the top performers within the STI, the top five of them, three of the five are bank stocks. They are local banks, DBS, OCBC, and UOB, and they're up more than 30%. And especially DBS is up more than 50%. And we know that the STI components weightage, half of the weightage is propelled by these banks, and therefore when the bank stocks are surging in 2024, it will pull up the entire STI index more than the other stocks. So I would say it's largely a bank rally in 2024 that have given rise to this STI component performance. Of course, we want to further understand whether these banks are overvalued and whether they are still a good opportunity to invest, which I will share my views later on. Okay, so first of all, let's look at the fundamental performance, and let me just zoom in for you. And you can see that based on the third quarter performance or even the first 9 months of 2024, we have seen the revenue and the net profit grown more than 10% for most of the scenarios, right? Except for UOB, it's weaker for first 9 months. The growth was less than 5%, right? But if you look at DBS, it's double-digit percentage growth in both Q3 as well as the first 9 months of 2024. And OCBC is not that shabby as well, right? It's in between UOB and DBS in terms of the growth rate that we have seen in 2024. And one of the biggest reasons why the banks are doing well is because of the interest rates. And for the longest time, interest rate has been very low, and we know that in the last few years, what happened was the threat of inflation has caused interest rates to go up to tame the inflation down. And so far, interest rates are still maintaining at a relatively higher interest compared to, say, 3 or 4 years ago. Okay, so banks benefit from high interest because they lend out money and they can collect interest. And interest higher means that they make more revenue in that sense. This is one of the key reasons why banks are seeing very good performance, as well as that translated to their stock price performance. Looking at their valuation, right, we'll look at some financial ratios to give us a sense whether these banks are overvalued or not. If we take a look at the price to book ratio, which is a very relevant ratio for banks because banks are mainly about the assets that they have, right? Because they take depositors' money and then they lend it out for income. And if we take a look at this price to book ratio compared to the 5 years range, right, we can see DBS, the highest point was at 2 times price to book ratio, and right now it's at 1.97. So you can see that it's actually testing that upper limit, and that suggests that the stock is overvalued from this point. But this is not a full story, which I'll explain a bit more later. And same likewise for OCBC and UOB, they are trading very close to their higher end of the PB ratio in the past 5 years. So generally, from this price to book ratio perspective, these banks are overvalued. But if we look at the PE ratio versus the 5-year range, and you can see that they are not as overvalued as if we look at price to book ratio, right? So you can see DBS is about 11.39 times in terms of PE ratio. The highest is at 17 times. So it suggests that DBS actually not that expensive, right? Same for OCBC and UOB, they're actually closer to the lower end rather than at a higher end. So it paints a very different picture here. And how do we reconcile this? With interest rate at a higher level, that means that they are able to generate more income for the same amount of assets that they have. So from an earnings perspective, the banks are not expensive, right? I wouldn't say they are cheap either, but I would say that because of this new interest rate environment, banks are probably fairly valued now. And we bring in the third one, which is dividend yield. This is where I think a lot of investors are interested in because they invest in banks due to the generous dividends that they give. These banks have dividend growth over the past 10-20 years, which has been fantastic for a lot of dividend investors because they get pay raise whenever dividends increase. And even if you look at the current dividend yield, it's about 4-ish%. These are still attractive dividend yields in my opinion. Of course, maybe some investors prefer to be in the 5+ range, right? If so, then you probably have to wait a bit more for the price to correct or for the banks to increase the dividends further. So in this kind of situation, if you're holding the bank stock, it probably makes sense to continue holding it, right? Because they are not excessively overvalued. But from a buying perspective, you need to probably be more selective. They are not undervalued at this point, right? So if you're okay with the yields, you can consider to buy. But if not, then probably you should wait for a while. Then let's move on to the other end of the spectrum, right? The worst five performers in the STI. And if you take a look, two of them are REITs, and the rest, there's also a city development, which is a property related company as well. Then we have Genting Singapore and Emperador, which is a brandy company. So why I want to highlight the REITs part is because it has always been a very popular investment, right? As similar to the banks due to the high dividend yield that they offer. And we look at the worst performing REITs in the STI is Mapletree Logistic Trust and Fraser's Logistic and Commercial Trust, right? So logistics, okay? Maybe there's some commonality. I guess at least for Mapletree Logistic, they did flag out the problem, which is in the China properties are not performing, right? And that caused a dip in their distribution per unit, and investors eventually sell down the stock. And one of the key reasons, again, is the interest rate higher for longer. So if higher interest rates are good for banks, they are bad for REITs, because REITs borrow money from the bank and bondholders to buy properties. And they need to pay more interest charges, financing charges, when interest rates are higher. And there will be less dividends distributed to unit holders as a result. So you can see that on one hand, high interest rates benefit the banks. On the other hand, high interest rate harm the REITs. So it might not be a bad consideration when it comes to this portfolio management, right? So they tend to prosper in different kind of environment. Now let's zoom into the population of REITs listed on the SGX. And the bottom 5 have seen losses of up to 17% or more, right? And the worst performer is Keppel Pacific Oak US REIT with a 45.3% down for 2024. And this is inclusive of the dividends that the unit holders were received. And we also see another US related REIT, which is Prime US REIT, also down 20.9%. And it is not surprising because the US commercial or the office property scene has not improved. And the occupancy is still lower than desired. People still don't want to go back to work. They want to work from home. After COVID, that trend has somehow stick. Again, we see Mapletree Logistic Trust in one of the worst performers, as together with Fraser's Logistic Commercial Trust as well. And what about the top 5, right? The top 5 performers are Cromwell, Keppel DC, Lippo Malls Indonesia Retail Trust, and Elite UK REIT. Lastly is Manulife US REIT. Okay, so they gain 8.5% or more, right? Cromwell European REIT has gone up 24.9%, and because there's two repeated, one is Sing dollar, one I think is in euro, so they have different returns due to the currency difference as well. And probably the most popular is Keppel DC REIT, which I covered during the acquisition of the local data centers. This is one of the probably the most popular REIT among these top 5 players, right? Why I want to highlight that is because if we lengthen it to the 5-year performance, that Keppel DC REIT is the only one that deliver a positive return. The rest of the REIT actually has very big losses, right? Like Lippo Retail Trust have like 89% down over the 5 years, and Manulife US REIT is also down 88%. So this is just to show you and give you a balanced view, even though that for the past 1 year, some of these REITs have performed very well, but over a longer time, they actually lost money. Okay, so I wouldn't define them as good REITs. They are definitely riskier, and the prices are more volatile. So the past 1 year is more like a rebound because their share prices were depressed for too long, right? And interest rate expectation has definitely improved from a year ago after the Federal Reserve had cut rates. And if you look at the better long-term performers, right? So now I included not just the 5-year, but also the 10-year performance, and I selected the ones that have at least 5% return per year over the last 10 years. Of course, historical performance is not indicative of future returns, but okay, this historical performance is still a good yardstick for us to determine whether a REIT is higher quality or lower quality, right? Because over the long run, it must deliver returns, okay? And otherwise it is a moot to the investor. So using that as a filter, we can see these are so-called the higher quality REITs. Of course, the devils is in the details. Some of the properties may not be as good as they were going forward. And some of them may have also met some challenges like Military Logistic Trust, which I mentioned just now, right? Other than that, if we take a look at this list, I would say that you will find quite a number of them have a heavy allocation to local properties, like Capital DC is one, Fraser Center Point Trust is another, and of course CICT, Capital Land Integrated Commercial Trust, is largely Singapore as well. So we can see that the Singapore properties, as I said, are more resilient, and these are the ones that will give you less sleepless nights over the long term. Maybe there's an opportunity, right? If the long-term returns are good, and in the short term, like the 1 year return, they have a negative return, okay, it suggests to you that the share price is lower. And if you assess that the stock still have, or the REIT have good properties, and the future prospect is not impacted or impaired permanently, they may become investment opportunities, right? But I would say that largely REITs are undervalued, right? Because they have been beaten down in the past 3 years due to the rate hikes that we have seen. Even though rate cuts have happened, it is not near zero. So we should not expect REITs to perform as well as they had when interest rate was really close to zero. And now banks are laughing and enjoying in the high interest rate environment because they're generating a lot of profits. Okay, so you can see that the cycle has changed, and this environment is definitely better for banks over REITs. So interest rate, the theme now is higher for longer. We don't expect rate cuts to be very aggressive, and definitely not close to zero, right? And it is good for banks and generally bad for REITs, right? But I wouldn't say that totally avoid REITs altogether. There are still quality ones that you can buy at good prices, and bank stocks have already seen their share price gone up, and they are not undervalued anymore. They are more like fairly valued to reflect the current operating environment or the macro interest rate environment. And most importantly, the economy must continue to grow, right? And for Singapore, the good news is 2024, it grew 4% above the expected 3.5%. And that's a very strong growth considering that we are a developed country. And this growth is important for both banks and REITs. You want businesses continue to borrow, consumers continue to borrow and invest their money, and you want REITs to have high occupancy, which means businesses are renting our spaces as well, right? So if the economy is not doing well, worse, it goes into recession, it will impact both banks and REITs. Okay, so the best scenario going forward is that interest rate cuts are gradual, right? And that continue to benefit the banks, and REITs may get some reprieve as the interest rate goes lower, and economy remains strong such that the demand for loans and demand for real estate continue to be high. Okay, of course, I hope that for 2025, but we won't know exactly what will unfold. But when that happens, then we'll probably do another video again. Okay, so I hope you have a good idea what's going on, at least in the Singapore market where most investors are interested in banks and REITs. So this will give you a good overview for 2025, and hopefully you have a better idea where to put your money. Hope you like this video. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.